Hello everyone and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, we're actually going to go ahead and tackle one of the most cash flow sucking loans that you can have, right? We understand that Velocity Banking works at student loan level, home loan level, car loan level. But what I want you to remember is that it's all about capturing that cash flow. So that auto loan has been proven to be the most cash flow sucking loan in your arsenal, in your portfolio. We need you to get rid of that car note paid for, no car payment. That's what we want you to live, okay? And we're going to do that with 2 auto loans, all right? Listen, I want you to like, share, and subscribe so that everyone around the world can experience the euphoria of Velocity Banking, especially when it's in their day-to-day finances. Now, folks, I understand the economy is doing something that you didn't expect it to do. That's okay. Okay? You know why? Because it's not about what the economy is doing, it's about what your personal economy is doing. So as we go through these loans and pay them off, please remember that. Now, as we do in every video, we want to make sure that we have an overview of what we're talking about. When it comes to loans, it doesn't matter if it's an auto loan, a home loan, a boat loan, a personal loan, a payday loan, a title loan. It doesn't matter. I've seen loans as high as 109% get paid off without worry, without anxiety, because people are utilizing and allocating their finances the right way, okay? So we have the line of credit on this side. If you don't have a line of credit, that's okay. Just go ahead and picture a checking account on this side. And then we have the loans, right? We have one auto loan at $20,000. We have another auto loan at $30,000. And we're gonna show you how to pay these off so that you don't have to worry about their 5-year terms, right? Because these are each 5 years. You're not going to worry about that. We want to pay them off in less than a year, right? Maybe 1, maybe 2. We'll see. All right. Now, when you have the $10,000, you may have had an introductory rate, okay, of 0%. So what does that 0% mean? Well, when you're doing the Velocity Banking, that means you start getting stuff for free. When you have a 0% interest rate, introductory, you can start getting stuff for free. Why? Because when you go in to pay $2,000 with that line of credit or that credit card, when you go in to pay the $3,000, $4,000, $5,000, guess what? When you're implementing the Velocity Banking method and there's 0% interest, you are sticking your income inside of your line of credit, and you're also spending from that line of credit. That means if there's $5,000 going in and $3,000 going out, $2,000 is paying it down. What's the interest? If it takes you 3 months, 4 months, 5 months to pay that off, what's the interest? 0, remember? Because you use your line of credit as your checking account. However, it's not that way, right? That introductory or honeymoon rate is up. And now we got to get to real life, 21%. So how are we going to pay down these loans with this $10,000, right? First of all, we got to pay down that $10,000. So here we go. $10,000 is getting paid down. Remember, your income, let's say, is $5,000 each month, right? And $3,000 is your outgo or your expenses, which means there's $2,000 in cash flow left. Let's go ahead and pay this off. How long is it going to take us to pay off $10,000? Well, 10,000 divided by 2,000, okay? Let's go ahead and do that. And that's going to equal 5 months, okay? Now, yours may be a little different, but it's the same, because we're going to be taking the line balance, we're going to divide that by the cash flow. That's how we end up with our velocity term, or how long it takes us to pay off that line of credit. Now, why do we want that line of credit paid off? Well, because now we're not going to use the line of credit to buy Jimmy Choo's anymore, at least not yet. So ladies, please forgive me, but you're going to thank me later on. Listen, we're not going to use it to buy J's. We're not going to use it. We're going to use it as a debt elimination weapon, which we're going to make sure that that $10,000 goes to one of these loans. Yes, there's a lot of ways you can do it. A lot of ways. But we're going to try this one, all right? We're going to make sure we're putting it towards the right loan because we want to make sure that a loan that is the most inefficient is paid off first. So let's do some math. What's 20,000 divided by 396? Now, why did I do that? Why? Well, because we want to make sure that we're running all of our loans through the cash flow indicator method, which is going to show us what's the most efficient loan and the least efficient loan. Let me show you what I mean. Don't worry, you don't have to do the math. I did the math for you, remember? So we have the lines here so that we can block it off. Borders just make things a little bit neater. So 20,000 divided by 396 is 50. And 30,000 divided by 566 is 53. So you remember, on the inefficient to efficient cash flow indicator, we remember that 50 is what? 50 is part of that inefficient loan. So it's still an efficient loan, but guess what? We have a more efficient loan in the $30,000 loan. Now you would wonder, wait a minute. There's more cash flow going out. How is that more efficient? Well, look at what you have. You have a $30,000 loan, but you're paying $566, right? Now, if it was $30,000 divided by 700, now that is going to be less efficient, right? It's going to be an inefficient loan. But since it's not, we are going to pay off what? The inefficient loan first, which means this loan is our target. So imagine this. You walk in with your credit card that you just got from MasterCard or Discover, and you say, listen, take $10,000 and apply it to my principal, please. All right? And so now the principal is going to go down from 20,000 to 10,000, which means that's where you'll be at on the amortization table, paying way less to interest than you would if you were just paying it $396, right? And so now what you'll need to do is you'll need to continue to make those $396 payments, right? That's already in the budget or the money allocation plan, all right? Already got that in the expenses, okay? So you're not hurting for anything, right? Now, at the end of the 5 months, what happens? Well, the end of the 5 months, remember, you already have this replenished. So at the end of the 5 months, you can go ahead and deploy it again because that's our weapon, okay? So we're going to go ahead and deploy it again. And, right, we've already done with the 396 payments. We're deploying it to the principal again. What is 10,000 minus 10,000? 0,000. And so you're done with that loan. So that $396, where does that go? That goes to your new cash flow, which is now $2,396. Is that going to help us pay off this loan much faster? We'll see. Now I know it's on your mind. CJ, where did the $396 go? Where did the loan go? Well, remember, we paid it off in about 5 months, okay? Not 5 years, okay? And guess what? That $396 actually went to our cash flow. So now we're paying loans off in 4 months. We're paying, right? We're paying the $10,000 off that we're using from our line of credit. We're going to pay that off in 4 months. So it's really no big deal. So we can go ahead and use that as a weapon again to make sure that this loan goes away just as fast as the other one did. Now, remember, when you score a 53, and I need to say this, it's the caution zone. When you have a cash flow indication, just like this loan does, of 53, that's in the cautious zone. Remember, 51 to 99 is the caution zone. What does that mean? That means you can refinance, okay, to make it even more efficient. You can refinance, you can restructure the loan. You can ask for a lower percentage rate on different loans, right? Not necessarily the auto loan, but on different loans, okay? Hey, ask your dealership, man. All right. So with the 53 and all the way to 99, you can make sure to negotiate. All right. Now, we're going to make this go away, but we need to make it go away the right way. So we're going to go in and we're going to say, listen, I've got $10,000 again. I want that applied to my principal. They'll say yes. Okay. Now you're at $20,000. And remember, it's going to take you 4 months to pay off that $10,000. Meanwhile, you will continue to make the payments of $566 a month on this particular loan, all right? And when you have replenished after the 4 months, 4.17 to be exact, then you can deploy the $10,000 again. That'll leave you with a balance of $10,000. And of course, you'll have to pay the $566 while you replenish your line of credit. And after another 4 months, you just deploy it again. What does that mean? That means that you paid off this loan in 8 months. And you paid off 2 loans worth $50,000 in about 13 months. So it wasn't under a year, but it is close to a year. Way less than 2 years. What are your thoughts on that? Let me just go ahead and... So that's how it's done, all right? This is how people are canceling their interest. They're using something that they weren't using before, or perhaps they were just buying shoes with it, they were buying candy with it, groceries, and groceries is pretty important, but dining out excessively. But then they say, wait, I can actually dine out excessively after this. Or you can dine out excessively when you have a plan. And that's why we talk about it all the time, man. Let me give you, right? Let me show you your debt-free date. And let me show you your velocity banking debt elimination plan. Because we are actually making sure people have these. We're making sure that they have the education. We're making sure that they have the tools that they need to succeed in debt elimination. Because when you eliminate your debt the right way, you increase your cash flow, which increases or rapidly reduces your debt payoff. All right? So folks, thank you so much for tuning in. I'll go ahead and get out of the way so you can make sure you get a screenshot of this. Please let me know if you have any questions, any concerns. I am here to make sure you get out of debt, because to be in debt is a slave. And I don't want you slaves. I want you free. God bless and take care.